In this video we are going to learn about bank loan securities and SMA fees. What is bank loan securities and its type? Bank loan securities are financial instruments that banks use to secure loans and manage risk. These securities are typically backed by underlying assets or collateral, which provide a level of protection to the lender in case the borrower defaults on a loan. The types of bank loan securities can vary depending on the nature of the loan and the specific terms of the agreement. Here are some common types. Mortgage-backed securities, MBS. These are securities backed by a pool of residential or commercial mortgages. Banks bundle individual mortgages together and issue securities that represent an ownership interest in the mortgage pool. The cash flows from the underlying mortgages are used to pay interest and principal to the holders of the MBS. Asset-backed securities, ABS. These securities are backed by a pool of financial assets other than mortgages. The underlying assets can include auto loans, credit card receivables, student loans, and other types of consumer or business loans. ABS provide diversification for investors and allow banks to transfer the credit risk associated with these loans. Collateralized loan obligations, CLO, are a type of ABS that are specifically backed by a pool of leveraged loans, which are loans made to companies with high levels of debt. CLO are structured in tranches of different risk levels, and investors receive varying degrees of risk exposure and potential returns depending on the tranche they invest in. Collateralized debt obligations, CDOs. CDOs are similar to CLO, but they are backed by a broader range of debt instruments, including corporate bonds, asset-backed securities, and other structured finance products. CDOs are divided into tranches with varying levels of risk and return potential. Secured corporate bonds. In some cases, banks may issue corporate bonds that are secured by specific assets or a pool of assets owned by the issuing company. If the company defaults, the bondholders have a claim on the underlying collateral. Warehouse receipts. Warehouse receipts are a type of loan security used in commodity financing. These receipts represent ownership of stored goods, such as agricultural products or metals, and can be used as collateral for loans. Letter of credit, LOC, secured loans. In international trade, banks may issue letters of credit to guarantee payments between parties. These letters of credit can serve as collateral for loans. Guaranteed loans. These are loans that have a third-party guarantee, often provided by a government agency or another entity. The guarantee reduces the risk to the lender and can make loans more accessible and affordable for borrowers. What is SMA fees and accounting treatment? SMA fees typically refer to separately managed account fees, is just what it sounds like, a portfolio of securities that's professionally managed separately from other portfolios. The portfolios are made up of stocks, bonds, and other securities and can be customized to align with an investor's unique goals and preferences. SMAs are managed by investment professionals and designed for high net worth (HNW) individuals who have specialized or sophisticated needs and seek bespoke investment solutions. The money manager makes investment decisions based on the investor's objectives and risk tolerance. SMA fees can vary depending on the money manager and the investment strategy, but they generally include two main components. Management fee. This is a fee charged by the money manager for their services in managing the SMA. It is usually a percentage of the total assets under management, AUM, and is typically charged annually or quarterly. Performance fee. Some SMAs may also include a performance fee, which is an additional fee based on the investment performance of the account. It is often a percentage of the profits generated above a specified benchmark or hurdle rate. Accounting entries for SMA fees. Let's assume you have an SMA with a management fee of 1.5% per annum and no performance fee. The accounting entries would be as follows. When the SMA fees are charged for the period, e.g., quarterly. Debit. SMA fees expense, income statement, 1.5% of AUM for the period. Credit. SMA fees payable, liability on the balance sheet, 1.5% of AUM for the period. When the SMA fees are paid, assuming in cash. Debit. SMA fees payable, liability on the balance sheet, amount of SMA fees paid. Credit. Cash, asset on the balance sheet, amount of SMA fees paid. Thanks for watching. If you liked it, hit the like button and subscribe for more videos.